we're hitting target metrics, okay? You need to understand what's important in evaluating a business. Before we get to the fun negotiation stuff, and all, I mean, everybody loves that, at least most people do, and if you don't, then hire someone to help you with it, right? But you need to understand what's important in evaluating a business. And also, I also want you to analyze this in terms of your own business. Really, where are you at in terms of your own company? Would someone pay you top dollar for your business, all right? And the answer is no, then there are reasons for that, and there are things that you can implement starting basically tonight to change that. Every single person in here should be a seller at some point, okay? Eventually, even if your kids will inherit the business, okay? The kids inherit the business, you won't sell it. Your business will be sold or should be sold at some point. And if you think in your mind, it's not worth anything, I'm just going to throw it away, right? Then number one, let's change that. Your business should be basically almost like a cash policy waiting to be cashed out, okay? That's how you need to think of your business, right? Where it's incredibly valuable and will sustain your family. If you were to pass and your business ceases to exist, what amazing loss. Amazing loss. Your business should be able to fund your family's lifestyle, okay? Because it's structured in a way where it doesn't matter who the owners are. You see what I'm saying? So anyways, just a little bit of that, okay? So we're going to talk about target metrics. Okay, so let's see. I first want to see, just for fun, okay, and this is in the workbook, what you value the most. What do you find the most important in a business? And it's not just for fun. It also will help you target the right business. Remember, we talked about basically finding the right fit for yourself in terms of a business target, all right? This will also help you. Different businesses are just like any other asset, okay? Any kind of business is going to have specific characteristics, and so depending on what you find most valuable to you is going to dictate what you want to do, okay? So in your workbook, go through this, all right? It is on page 12, okay, 5.1. Rate what you find to be the most valuable in a business or even your business, right? And then we're going to compare this against what is standard in terms of business valuation, okay? So go through this. This shouldn't take you long. I'm just going to keep on talking while you're working here, okay? So here's basically what the checklist looks like for you. Recurring revenue. Oh, yeah, that's really awesome. But what about profitability? Oh, I like profitability. Who doesn't like profitability? Client concentration. Now, client concentration, what that means is instead of having 1,000 clients, you have 10. So high client concentration is, I got a $2 million business, and it's either continually be recurring, right? Like where there's just new people every single day, and there's no client concentration. There's continually just like an assembly line, right? Kind of business. Or I got 10 people, and those people fund my business, and that's what gives me my $2 million. Okay? There's pros and cons to each, all right? Because if you got 10 clients that give you $2 million, right, what happens when one of them drops off? Your business just dropped significantly, okay? So it's important to understand that. All right, systems and processes, right? And just for fun, don't just rate all of them as a 5, right? Give yourself a little bit of variation here, right? You're like, oh no, all of them are super important to me. All of them are 5s, right? Kind of rate yourself, to be honest, right? Your systems and processes, your PSPs. Who doesn't love writing a good SOP, right? Oh, I just love writing SOPs in the morning, said no one, right? I'm joking, right? Elizabeth is laughing in the back there because I'm constantly, we got to update our SOP book, right? I got like a book, it's like this big, right? It's like all of our SOPs have taken years. It's fun, all right? We have a little SOP contest or something, who knows, okay? Growth potential, brand. So anyway, so you can have a low revenue, but what if the growth potential is 100% year over year over year over year over year? I would take that any day of the week as opposed to a flat line with 2% growth at $2 million. I will take the $200,000 business with 100% growth year over year as opposed to a $2 million business that has a 5% margin or whatever. You see what I'm saying? There are differences. You need to understand them, okay? Brand and IP strength, okay? If you don't understand intellectual property, okay, number one, I've got an entire webinar on it, and I could give it to you, right? If you haven't met Scott from my team, he's a licensed patent attorney. If you haven't had the pleasure of meeting him yet, you should definitely come talk to us. We'll help you with that and understanding copyrights, trademarks, patents, and trade secrets and all that kind of stuff. If you don't understand that and you're not leveraging it, that's a lost opportunity, okay? Or at least currently you are not you're underutilizing your intellectual property, okay? Market position, risk, and liabilities, okay? Risk and liabilities should be fairly high in terms of its importance to you. If you don't care about risk and liabilities, you won't be in business probably for very long. Like, I don't care about following the law. Why do I give a shit about that, right? It's something to maybe think about, and maybe you probably want to adjust that mindset, okay? So anyways, hopefully you guys all have that, all right? So let's talk about now what you want to, how businesses are basically valued, okay? So how a business is valued, okay, let's take a pause here, all right? There are lots of ways to value a business, okay? The key thing to know is that a small business, by definition, is not on the NASDAQ or anything like that. It's not publicly traded. Once it's publicly traded, it's no longer small to medium to even large businesses, but it's not closely held, okay? Because there isn't a market for it, a business is basically worth, in general, what people agree to, okay? Like Apple has a price per share, right? You understand that? Like small to medium-sized businesses are basically worth what people agree to. However, there are metrics that are generally used to evaluate a business. EBITDA is one of those metrics, okay? It's basically the profit before all these various things are taken out, okay? Interest, taxes, depreciation, amortization, whatever. It's basically, it's generally, there's a range for it, but it's generally going to be higher than your net profit, okay? When you hear EBITDA, is just a way, it's just a formula. It's just a formula. We punch it in there, we can come up with your EBITDA, okay? Now, the next thing you need to know is I already talked about that. It's a measure of operational profitability before deducting all these various things, okay? So, then the EBITDA is then multiplied, okay? Multiplied by a multiplier, okay? And there are multipliers that are standard in the industry. There are multipliers that can vary based on how successful the business is, how well is it run. Like if I could have someone step in my business and there'd be no loss, okay, of anything, right? The multiplier will be higher because that means anybody could come in there and run it. Like a car wash. Do I know who the owner of the car wash is? I don't give a shit, all right? I want to just wash my car. You see what I'm saying? Doesn't matter who owns it, right? Then again, if the machinery is crappy and is inefficient, it doesn't do a very good job, obviously that's going to lower it. You see what I'm saying? So the multiplier is you take the EBITDA and then you multiply it by, it could be 2 times, 3, 5, 7. Tech industry, tech companies, very valuable, high multiples, right? So then you get this 10, 20, $50 million business. Value, okay? We're not talking about revenue. We're talking valuation, okay? Extremely different, all right? So that's EBITDA, okay? Anytime you talk to a broker or you're negotiating a deal, you need to understand this, okay, and what this is. This is a very common metric to how to evaluate a business, all right? Not the only metric, I didn't say only, but very common, okay? This is kind of the industry standard, okay? So let me give you an example, all right? Let's say the gross revenue is 1.2. The expenses, 900,000 total, so your net profit is 300,000, okay? Now, let's say the EBITDA is generally speaking is going to be a little bit higher than net profit. Obviously, depends on the business, right? So I'm just giving you, this is just a random example. And let's say the business is fairly predictable. It's not like amazing, but it's kind of average in terms of that. So maybe you get a 2.5 multiple. So now you're looking at a $1 million value, okay? That's basically how this would work. Okay? Now, obviously, this is what gets negotiated, right? One person's going to say, well, my staff is automated, my systems are automated, everything works without me, and that kind of thing. But the other person says, well, yeah, but the client concentration, you have 2 clients that give me the entire 1.2. If I lose 1 client, my business just got cut in half. So the multiple is far less than what you're saying. You see what I'm saying? This is how this works, okay? This is why attorneys and brokers have fun doing this stuff, right? So, okay. So let's keep on going, okay? So what would justify a higher multiple? And by the way, you can have businesses with far higher than this. I'm just giving you a kind of a starting point in terms of EBITDA multiplier, all right? Recurring revenue, right? We don't have to hunt every single day, right? Like I've got contracts in effect. I got all these agreements in effect. I'm going to continue to get income for longer periods of time, right? The longer the recurring revenue is into the future, the more valuable the company is because then I don't have to worry about it, right? Like for example, does anybody in this room do government contract work, either California or the feds? Anybody? Some? Okay, great. A few. Okay, so you get a 5-year contract. Guess what? I got income from the federal government for the next 5 years, right? And they are going to pay, all right? They will pay on time, okay? So that's extremely valuable as opposed to if I don't hunt for next week, I got no income next week. You see what I'm saying? Significantly different in terms of value, okay? Low client concentration, meaning that it's not dependent on just a few people, okay? We've got like a good client base or customer base or however the income is being generated. Owner's not essential, okay? If that, like for example, there's certain contractors that it's just one guy, and he's got a great reputation, but if that guy isn't there, the business doesn't exist. The business has no real value or it has very, very low value. Like, what am I getting? I got tools and a name, but it's your name. You see what I'm saying? You see how there's a difference here? That's extremely important to understand. Clean books, decent brand, solid growth. We got 3 years of increased profitability year over year over year. The last 3 years, I've been increasing my profit. You know, I'm looking at net profit. When I'm looking at a company and the acquisitions that I've done, I'm looking at bottom line. Excuse me. I don't give a crap about the top line. All right, if you give me $1 million business with a 1% margin, that is worthless to me. That is worthless. I'm not interested in that. Why do I waste my time? Okay, unless I feel like I can completely gut it and make it extremely efficient. But then, how much time is that going to take me to be able to do that and completely overhaul a business? It's not valuable. Maybe I get it, but I'm going to give it to you for pennies on the dollar. You see what I'm saying? So this is something for you to understand about your own business, okay? Now, let's go through a poor multiple, okay? If the business is extremely owner-dependent, spotty books, poor records, right? Relies on a single or just a few large clients, right? Now, I would say that if you're selling a business that relies on government contract work, you're like, well, yeah, I have one client, it's the federal government, though, then I feel a little bit better. I feel a little bit better about that, okay? So anyways, so this valuation will incredibly be modified based on what multiple is getting. Do you see where I'm going with this? This is extremely important for you to know and understand, okay? And also, this is how you negotiate deals, and these are the grounds that you can use, by the way, when you're approaching a seller, and he's saying, oh, no, I'm at least a 5X. Well, then show me the justifications for that, because right now it looks like the business won't go on without you, right? So show me the justifications for a 5X, you know, that kind of thing, you see? The EBITDA is EBITDA. There is no negotiation what EBITDA is. It is what it is. You see what I'm saying? It's like saying, what's your gross revenue? Unless you're cooking your books, your gross revenue is your gross revenue, right? Your multiple is where really the action happens, okay? So there's really nothing really for us to really like an assignment to do on this kind of thing. I want you to understand this because it's extremely, you can't really go into any kind of acquisitions without understanding the difference between top line, bottom line, and EBITDA and all that kind of stuff, and multiples and that kind of thing. Okay, so red flags for you to look out for when you're looking at a target. Okay, you're looking at a target, here's what you need to be wary of. Some of this is, we've already discussed this. If there's over 30% on a single client, okay, that's an issue, because if that client defaults, declares bankruptcy, breaches a contract, or just, terminates the agreement or whatever, you just lost 30% of your revenue. Holy crap, that is a really big concern for me, okay? The owner is the business. They have no systems, no team, okay? That is significantly less valuable. They'd have to either have some amazing assets, some amazing intellectual property, perhaps an amazing name. Maybe they got really good, because they have really good branding, then they're getting a lot of income or intake kind of thing from their numbers, and you can take the numbers, that kind of thing. But regardless, if the owner is the business, that business is worth significantly less, okay? Declining revenue, that seems to be fairly obvious, right? If your revenue is declining, unless there's a really substantial, and there's a short period decline, it's like, well, my revenue declined because I'm optimizing a new thing. I'm going into R&D research. There's got to be a justification for it, but there's no adequate justification for it. Either way, that's a red flag, okay, if your revenue is going down, okay? High employee turnover, okay? Why would you want, because what's going to happen, what would you guess is also the case if they have high employee turnover? What else is going on? Culture fit. A client turnover, there's probably some labor hour, wage hour violations, right? Like, how long is it going to take before there's a wage and hour claim against them with high turnover? It's going to happen, right? It's going to happen, right? So you need to be extremely careful if you're approaching a business with that. Because, and here's another thing, is if you buy the business, you just say, well, I just want your assets. I don't want your staff. I'm just going to take the assets. But I step into that role, and they basically assume that role. There's something called successor liability, okay? If I step into that role, I'm like, I got my own entity, the staff's over there, I don't care. But I got the same name and the same clients and, whatever. That liability will follow you, okay? Because you're basically stepping into the shoes of the seller and pretending to basically be the same. So you can't avoid that kind of liability by doing it that way, okay? There are strategies that you can utilize, but be very cautious with successor liability, okay? I've seen some entrepreneurs burn badly because of that, okay? So be very careful, okay? All right, there you go. Pending lawsuits or tax issues. Oh, well, I don't have any lawsuits, but I have this massive IRS lien, and they're coming knocking on my door, and they're about to foreclose my property. Holy shit, I'm running the other way, right? Not going anywhere near that thing, all right? Okay, so anyways, those are the red flags, okay? Are there more? Sure, but those are the main things, like a lot of infighting, insider attacks, business partners are tearing each other apart, those kinds of things. So it's kind of similar to what we just talked about, okay? So what I want you to do for fun now, okay, well, hopefully you're having fun this entire time, right? But, I'm having a great time, but I want you to apply this to your own business, okay? What do you think someone would pay for your business, even if you don't have, I don't expect, if you just pulled your EBITDA out of your phone, that would be, number one, that'd be impressive. Like I carry my valuation with me all the time, David, what are you talking about, right? I got my P&L right here, boom, right? But I want you to speak generally, okay? Look at your business. Now go through the same metrics that we just went through, okay? You should now have a better understanding of what's important in a business sale, okay? And go through your own business and now rate yourself in terms of the metrics. How strong are you for recurring revenue? How strong are you in terms of your profitability? Et cetera. Okay, so go through that. And if you have multiple businesses, I know most of you here in this room have multiple companies, then just pick one. Okay, just pick one. Pick your primary. Okay, whichever business you love the most. I don't care. It doesn't matter to me. Some additional questions for you as you do that. Okay, if you tried to sell your business today, what would help you get top dollar? Okay? What weaknesses have you identified? All right? What weaknesses would scare buyers away? Now, I'm going to give you a little bit behind the curtains right now why we're doing this. It's easy for you to analyze your own business. You know your business, right? You know the weaknesses. And if you can identify, oh yeah, this would scare away a buyer, then when you're the buyer, you see where I'm going with this? Now you can analyze it this way, okay? But you start out by analyzing your own business. What actions? Now, this will also just help you in general, guys. Even if you do not purchase another business, you analyzing it this way will help you grow your business substantially, okay? Identifying weaknesses. You should be increasing your EBITDA. This would just be a fun thing. You could talk to your home with your kids about it. Like, hey, guess what? I'm going to increase my EBITDA. It might be fun. You never know, okay? And then they'll grow up to be accountants or something, okay? So what 2 actions, okay? Because your value on your business should be increasing every single quarter, okay? And you need to target what weaknesses do I need to grow? What strengths do I need to leverage? Okay, so take a minute and go through this exercise now. You are looking at page 14 and into page 15 on your workbook. All right, let's take a minute and do this right now. All right, let's keep rolling, guys. If you're not finished, no problem. You can come back to it. Want to get the juices flowing here. A great question that was brought up during some of the work time here was about your total owner benefit kind of benefits in your business, okay? So when you are basically rolling out, when I say TOB, total owner benefits, your car that you're running through there, the meals, kind of all that kind of owner type stuff, what I typically do when I see in financials, especially as it relates to stuff, is a separate area of the P&L that basically identifies that kind of stuff. Because really, if a new owner were to come in there, that's going to go to the profit, right? So you shouldn't reduce your value based on your TOB, okay? Like that, a lot of that stuff is going to get added. It's called add back. You get added back into the to the bottom line so that you're not being penalized. Now, it will require your bookkeeper to do a little bit of work. If you're not already doing that, I would encourage you to do that. Stepping on like my bookkeeper soapbox for a second, make sure I would recommend that your bookkeeper do that because you want to position your business to sell, okay? You should position your business to sell, and by preparing that in advance, it will help you do that, okay? Versus, oh, I got a 5% margin. Well, actually, if I took out all my owner benefit type stuff, I'd have a 10%. You see what I'm saying? So that's important to understand that, okay? So let's keep rolling, okay? All right, so now we're going to hit on the build it stage, okay? So buy it, build it, sell it, right? That kind of thing. We've been talking about the buying and the selling, right? But now we're going to talk about how to build it. We're going to apply this to not only your current business, okay, to increase its value substantially, but we're also going to talk about the business that you acquire. Again, you should be acquiring businesses that you anticipate an exit on, okay? I want you to assume that. You're going to be acquiring something, you're going to have it, you're going to build it, and then you're going to sell it, okay? And typically you're going to see about 3 to 5 years. Generally no more than 5 if you're doing it as an investment asset, okay? This is an asset. You're not adopting a child. Not everyone was here earlier when we talked about this, but if you see your business as your baby, now you got to diaper it, now you got to take care of it, it doesn't do anything without you, you got to tuck it into bed at night and that kind of stuff. I got enough kids at home, okay? I don't need another one, all right? My business is an asset. It is here to generate. My business is to provide value, of course. I love what I do, but at the end of the day, my business is an asset. This is how I view it, and now how I want you guys to view it too. Does not mean that you don't love your clients, okay? It doesn't mean you don't love your staff, right? But you need to look at your business as an asset, okay? So, on that note, so we're now going to discuss the build it tactics of how you can substantially increase the value not only of your current company, but your company that you will acquire and the other ones that you acquire after that, okay? All right, so, yes, go ahead.
Why is it the max 5 years?
That's just the question was, why is the max 5 years? That's just what I see on average. You could either be significantly less or significantly more. Great question. So the question was, in case you didn't hear, is, especially those on Zoom, is for all your businesses, it's basically what I see is when someone's getting into a company with a set exit plan, that exit plan for this new company that they're acquiring is on average 3 to 5. Okay, it could be less, it could be more, right? It's that kind of thing. It's like flipping a house. Think of it that way. It's less confusing if you think of a house, right? People buy a house, they fix it up, and then they sell it for a lot more. Right? They're not going to sit there and hold on to it unless that's their strategy, where I'm going to rent it out. It's a long-term play. But if I'm buying it to flip it, then I have it for a short period of time, basically do the work, right? So that's kind of the same kind of thing. If you compare that to like a business, then it makes a lot more sense, okay? So, so buying the business is just the beginning, all right? When you make the business run smoother, you're going to increase its value, okay? Its efficiencies, its effectiveness, okay? This is the build it phase. All right, so when you increase the EBITDA, remember, you want to increase EBITDA. One good way of doing that is decreasing risk to the buyer, okay? Imagine yourself in the buyer's shoes. This is why we're doing this, so you can see it from the other side, all right? Now imagine yourself as a seller, so when you step into the buyer role, it makes sense to you, okay? So here's great ways. Now, I'm going to give you a whole bunch, okay? Do not sit here and go, David, I'm going to do all of them. You could eventually, but it'll take you a lot of time, okay? I want you to pick and choose, not only for your own business, all right, but things that I really would like you to look at in terms of given your skill set, okay? Given your skill set, what would be the easiest for you to do, okay? Et cetera, okay? If you are an amazing leader, and I'm talking about you have incredible charisma, and people will follow you into battle, right? Then increasing culture would be very easy for you to do and to create a good work environment where the team is operating more efficiently, more profitably. Okay, that could be an area that you step in very easily given your skill set, right? Or if you're on the back end, you're like, I am really good at finding inefficiencies. I'm going to make this thing efficient. I'm going to increase the bottom line solely by identifying redundancies and increasing efficiencies. That's a great skill set to have, okay? But you just need to work on this based on your skill set, okay? So, some things on the left, okay? We're going to increase predictable revenue. All right, for example, getting more subscription-based services or that kind of thing. So it's very much ongoing maintenance services, that kind of thing. Just hitting a couple of these, reducing dependency on the owner. I would be cautious even buying a business that was so dependent on its owner, right? Because what's going to happen when the owner isn't there? That kind of thing, right? Strategic upsells, identifying IP issues, cleaning those up. A member of my team, Scott, if you haven't met him, make sure that you do. He'll be here tonight. But he is very skilled at leveraging IP and increasing substantially a business's value by leveraging its intellectual property. If you don't know what I'm talking about, talk to me later. That is a very powerful resource to really drive up the value not only of your business, but of other businesses that you're acquiring, okay? More items for you. Scaling the team, increasing leadership, right? When my wife and I first started out, basically, our business model, if you were to draw out the organizational chart, was Andrew and I at the top, and then everybody else in one solid straight line, okay? It was everybody. It was like 20 people and us. Holy crap, was that stressful, okay? Everybody coming in and out of our office. There wasn't PSPs, no systems. It was just, Oh my gosh, it was like we're running a daycare, right? I mean, it was insane, right? But now, where we're at now with Shoop Legal is now there's like about 3 or 4 different tiers of teams, right? So everybody, they're like in little clusters. That's how the Marine Corps does it, by the way. Like in the Marine Corps, you got 3 people that you're in charge of, 3 to 4 tops, right? So let's just say there's a team of 4. You got a team leader, you got 3. And then your squad leader, you got 3. And then that's why they do it that way, right? Right? I mean, you take the model from the most successful military branch on the planet. Yeah. Okay. Automate, building and onboarding, restructure entities, etc. So these are the things that you want to hit, okay? When you are scaling your business and you want to increase its value, this is what you're going to do. And when you want to do this in 3 years, guess what? You need to do this pretty efficiently, okay? And for your own business as well, okay? It's not just profit. People think, all I got to do is just really increase the profit, and then the value will just be whatever I want it to be. No, right? If you got high margin, but your staff isn't there for longer than 5 minutes, number one, I don't know how that'd be possible if you'd be highly profitable and had high turnover, but you need to identify these issues, right? This is how you're going to do it.